Hi guys, welcome to the channel. Today's video is all about mortgage affordability. Now, we're going to be speaking specifically today about affordability for residential mortgages. Okay, so if you'd like to, I'll do a video on buy-to-let mortgages, but today is specifically on mortgage affordability for residential purchases. So let's take you right back to 2013, 2012. If you wanted a mortgage, it was fairly simple to sort of understand how you got one. Most lenders would work on the basis of 4 times your gross income. So if you earn £30,000 a year, for argument's sake, they would assess your affordability on 4 times 30, which is 120. So they would lend you £120,000. In 2014, the FCA did something called the Mortgage Market Review. And from that, all of the lenders altered slightly the way in which they assessed mortgage affordability. So some of them do still operate on a pretty similar scale to the 4 times mortgage multiplier. Some would be more, some would be less. But the fact is, they've all slightly altered it since 2014. So let's take it back to basics then. When we're looking at mortgage affordability criteria, what are we talking about? What's a mortgage broker going to ask you? Essentially, employment status, income, credit history, expenditure, and what disposable income you've got. Remember, every lender is different, and my advice would be if you want to try and find the best deal, you need to be speaking to a whole of market broker. That's a mortgage broker who uses their system to search all of the mortgage market. If you just go to TSB or Halifax or HSBC, then that mortgage advisor is only going to be able to advise on the mortgages that their lender does. What you want to be looking at to get the best deal, a bit like a sort of money supermarket, if you like, is a broker who looks across all of the market. Right, let's break each of those areas down. So when a broker is talking to you about employment and income, what are they looking at? So they want to know if you're employed, whether this is full-time or part-time, or if you're self-employed. Now, self-employed is slightly different, and again, I'll do another video on that if you'd like me to. So we're going to stick with those people who are employed in a full-time role. What they want to know is how long you've been with the company you're in, what your net monthly income is. They will probably request 3, possibly 6 months worth of pay slips to evidence what you are earning. They're going to ask you if you have any regular bonuses. So if you get an annual bonus of say £2,000, if you're that lucky, then you will need to take to them evidence that you are getting that as a regular dependable bonus, and also any evidence of other allowances that you might have. These tend to be, if you're working in a more corporate environment, i.e. for a bank, they might allow you allowances around fuel or money towards a vehicle or something along those lines. If you've got a second job, they'll take this into account, although when they're looking at your first income, they will always take into account 100% of what you earn as evidence. Sometimes when they look at second or even third forms of income, they may only look at around 60% of that. So just have in your mind that these are the sort of questions that your mortgage broker is going to be asking you. If you haven't been employed for more than 3 months, then to be honest, I would advise that you hold off until speaking to a broker, because they'll almost certainly ask you for at least 3 months worth of pay slips to evidence your pay. Okay, credit history. Again, I'm going to go into further detail on this one in another video. Essentially, what they're going to try and understand is what your credit score is, and they're going to do that by asking a number of questions. The reason that they're going to ask you these questions is because they need to determine how reliable you are to the lender. Okay, so they're going to ask you things like if you've had any previous bankruptcy claims, any CCJs, which is a county court judgment, any IVAs, which is an involuntary bankruptcy agreement, or if you're on any debt management schemes. Payday loans, they need to understand if you have a history of taking out payday loans, regardless of if you've got them now. if you've had any recent hard credit searches, which can adversely affect your credit, and if you've got a criminal record. Because essentially, if you're in and out of prison, then you're not going to be very reliable in terms of paying back the money that you owe to the lender. Building a credit score is really, really important. It's something that is not taught in schools. You sort of learn it as you go along. There are numerous ways in which to improve your credit rating, and there are numerous ways which some of you might not know about because they're not that obvious. There are certain ways that will actually damage your credit rating. A good thing to go on, it will cost you slightly, is Experian.co.uk will show you your numerical credit rating. So that will put on there what your credit rating is, why it is that score, and how you can improve it. So Experian is really, really good and certainly worth taking a look at if you're unsure about your credit rating. Expenditure. So what does the lender really need to know about your expenditure? Well, they need to understand your committed expenses every month. So these might be existing mortgage payments, any credit cards, loans, student loans, cars on finance. That's a big one. A lot of people these days have their cars on finance and don't really take that into account, but it is a form of committed expenditure, as is a dependent. If you've got a child, a young child under the age of 18, or children, then they will class these as committed expenses. Obviously, you've got to look after your kids, right? Oddly enough, though, they don't take into account, or they do, but not in the way that you might think, things like groceries, fuel, phone bills, heating, electricity, and all that. A lot of lenders will calculate those things from the National Statistics database. So you may actually come out well with that. If, for example, you're spending £80 a month on your phone and the national average, according to the statistics, is only £40, then they'll take into account the statistical database answers. Although if you're talking to a mortgage broker, they will want to get a real understanding of what these are. So essentially, from all of those questions, they will understand what your disposable income is, i.e., what you can afford if you are paying off a new mortgage every month. So if, for example, after all that expenditure, your disposable income is £500 a month, you could say, well, actually, I want to budget £300 a month for my new mortgage. That would be lucky, right? Then if you budgeting £300 a month, they could say, okay, well, we can offer you a 30-year term for your mortgage based on that. If you wanted to up your payments to £500 a month, then that mortgage may only be a 22-year term. Once you've given your budget and they've done their calculations, they've got great online systems. I can't even begin to explain them, but they've got a little system that they use where they input all this data, and magically the computer will come out and say, bing, we can offer you X amount with this lender for this period of time. What they'll then do is explain to you what's called a stress test. So interest rates are at a record low at the moment. In the future, they may go up. So if they offer you a mortgage on 2% or 1.5%, which would be nice, over 25 years, then they would say if mortgage interest rates went up to 4%, this is what your mortgage payment would be in the future. Could you still afford this based on what you've given us? Yes or no? Another piece of advice, and this is really, really, really good advice, make sure if you agree into a fixed rate mortgage term, after that fixed rate has been completed, then you remortgage with a different lender. Otherwise, you can agree a mortgage that starts off 2% fixed for 2 years or 3 years, and then after that fixed rate period is over, the interest rates could balloon up to say 4% or 4.5%, and your mortgage payments would also balloon in line with that. So make sure you're always shopping around for a good deal once your fixed term has ended, if you choose to do a fixed term. Okay, guys, so that's a very, very whistle-stop tour of mortgage affordability, what it is, the things they ask you. and the things that you need to be aware of. Again, I can do a deep dive on any area of that, for example, credit rating and how to boost your credit rating in a different video. Please hit like and subscribe and comment below if you'd like me to do that. Fantastic. Have a great day, guys. Take care.